Well, hello, everyone. This is Cynthia Tomaine with Interactive Brokers, and thanks for joining today's webinar on how traders, hedge funds, and investment managers can qualify for the new 20% qualified business income. So with that, I want to introduce today's presenter, Robert Green, who's going to be going through all of this information with us today. So without further delay, what I am going to do is, first of all, thank you, Robert, for joining us, and I'm going to go ahead and pass you the controls so we can get started. Thanks for joining us, Robert.
Thank you. And let me grab the screen here. I see I have it. And let's minimize.
Let's see if you can use the icon. There you go, in full screen
First,
access.
I want to just minimize my control panel. So just one second. Minimize. Okay. Thank you, everyone. And thank you, Cynthia. Today's presentation is how traders, that's when you trade your own money, hedge funds that trade other people's money, and investment managers who are the people trading for investors, how all three of them can qualify for the new 20% QBI deduction. QBI stands for Qualified Business Income. This is that pass-through deduction. Remember, the new tax law gave this incredible tax cut for C corporations, the big public companies. They got their rate dropped to 21%. But what about all of small business America, the pass-throughs? This deduction is for pass-throughs, only they've made it into a maze. And it's very difficult to actually wind up with the deduction. So you need to understand the rules. There are income caps, thresholds. Service companies don't do so well. Non-service businesses do very well. So you need to see where you fall out. And unfortunately, traders, hedge funds, and investment managers, they're service businesses, so really pay attention to these limitations. I'm Robert A. Green. I'm a CPA. I'm the managing member of our CPA firm, Green, Neuschwander, and Manning, LLC. And I'm CEO of GreenTraderTax, our content company. I'm considered a leading authority on trader tax, author of Green's 2018 Trader Tax Guide, which Green Trader Tax has published every year as an annual tax guide since 1997. The 2018 edition discusses the Tax Cuts and Jobs Act's impact on investors, traders, and investment managers. I'm also a contributor to Forbes.com, and leading brokerage firms and other financial media feature my blog posts and webinar content, like I do a lot of webinars with Interactive Brokers. This information is educational. It's not intended to be a substitute for specific individualized tax, legal, or investment planning advice. Where specific advice is necessary and appropriate, you may wish to consult with a qualified tax advisor, CPA, attorney, financial planner, or investment manager. A lot of clients have consulted with me about how they can get a QBI deduction, not just on their trading or hedge fund or investment management business, but other businesses that they're involved in, other investments that they have. No one wants to leave a 20% deduction on the table. I mean, for example, you make $100,000 in one of those investments, you can write off $20,000. It's not from cash spending. It's not from investing that money. It's not real cash. It's just it's sort of like a phantom deduction. Now, Robert Green and Green Companies are not affiliated with Interactive Brokers. We're a CPA firm, they're a brokerage firm. Here's the webinar description today. The IRS released proposed reliance regulations, proposed 1.199A. The code section is 199A. This has precipitated our new content. First, the law came out, and it was very helpful, but it always leaves a lot of questions and unanswered questions. So you wait for the IRS to generate regulations. We had to wait a long time. Now the proposed regulations have come out for this new area of the qualified business income deduction. And there are still questions. And we're going to then wait for the final regulations and then probably correction bills. So I'm going to show traders, hedge funds, and investment managers how they can qualify for this lucrative tax cut. the 20% QBI, qualified business deduction. Section 199A is complicated. There are several limitations, thresholds, income caps for service businesses, which include trading, hedge funds, and investment management. They're service businesses. It's done on the individual level. An individual taxpayer may deduct whichever is lower. This is the first limitation. Whichever is lower, either 20% of QBI from pass-through trades or businesses, or 20% of their taxable income minus net capital gains, and then they are subject to other limitations. So here's an example. Assume that you're a trader and you have 475 income and your net income is $100,000. There's a zero missing here. It's $100,000. Fix that quickly. Oops, sorry about that. So you might get a QBI deduction up to $20,000. That's 20% of $100,000, even though you did not spend any of the money. And the reason why you get it on QBI is because your taxable income, you have wages, you have other income, your taxable income is higher than $100,000. Now, again, it's not a business expense that you're putting on your business tax return. It's not an adjusted gross income AGI deduction like you would do with health insurance or a retirement plan contribution. It's not an itemized deduction, which is good because they've really suspended most of those. It's a new line deduction that's in essence from taxable income. And we'll wait for the new Form 1040 to come out for 2018, and it will show that new line item. Some traders and hedge funds might qualify. And it's not 100% clear. And what income qualifies, that's really the issue. So traders and hedge funds, if they're eligible for trader tax status, that's a term that we coined many years ago. That's our bread and butter business, trader tax status. They're service businesses. There was some confusion on that when the code first came out. We took a position that it's a service business, and the proposed regulations have confirmed that. Now, trading qualified business income, we think likely includes Section 475 ordinary income on securities trades. The regulations and the code excluded from QBI all capital gains, dividends, interest, commodities, and forex transactions. The commodities and forex transactions, that's a little hidden in the code, but it came out a little clearer in the regulations. So even if you have 475 on commodities, it's likely excluded because after all, you're getting 60-40. On most commodities, you're getting like futures, you're getting 60-40. They wanted to exclude things that could lead to other tax benefits, like a long-term capital gain. They didn't want double dipping. But of course, they did this with a broad stroke, and it wiped out a lot of our trading income for our clients, and we think that's unfair. But now with these regulations, it's not about what's fair, it's about dealing with the reality of the regulations. If the taxpayer does not exceed taxable income caps for an SSTB, they might get a 20% QBI deduction. So bottom line is, everybody in most businesses with most types of business income, not traders necessarily, but most businesses, you got QBI. So then it comes down to is, are you priced out of the deduction? Do you personally and or your spouse if you're filing jointly? And you may want to file separately because they did get rid of the married filing joint penalty a little bit with the rate brackets. So is your income too high so that you're priced out of this deduction on service businesses? On non-service businesses, you still may get a deduction, but there are other limitations that come into play, like the wage and property. So again, the QBI deduction and calculation are done at the owner level, not on the entity level. You and your buddy could both be owners of the same company. You might get a deduction because your income is not too high, and your buddy may not because his or her income may be too low. Too high. They may get a deduction because their income is low enough. Yours is too high, you don't get it. Now, investment managers they also probably qualify because, first of all, investment managers are a service business. That's clear in the regulations. This is the normal type of income. Advisory fees, that's normal revenue, but it's got to be from U.S. clients. It's domestic income. They don't want to reward you for foreign business. QBI likely includes carried interest of Section 475 ordinary income on securities trades allocated from hedge funds. So investment managers have management fees, that's advisory fees, that's QBI, but they also may get carried interest, a profit allocation. QBI excludes carried interest profit allocation of capital gains, dividends, interest, commodities, and forex transactions, but it likely includes the carried interest of 475. We're going to dig deeper into this during the presentation. So remember that income cap I was talking about when you get priced out of the deduction. So owners of SSTBs, that's your service, specified service trade or business, SSTBs, won't get a deduction on QBI if their taxable income exceeds the income cap, and this is the cap, $415,000 for married, $207,500 for other taxpayers. This is taxable income. So if you're over it, you get nothing. If you're under it and in the phase out range of 100,000 married, 50,000 other taxpayers, below the income cap, then you can get the deduction. You can get some of it, but it phases out. So the threshold is 315 married. You add the 100,000 and you get the phase out range and you get the income cap. They didn't want a fiscal cliff where $1 really gets you out. They always like to phase it in so people don't play games with managing their income. Now, in the phase out range, where every dollar you get into the phase out range is that percentage of that deduction you're losing. But also the wage and property limitations apply in the phase out range. So you're married, your income, your taxable income is under 315. Bingo, you get the 20% QBI deduction if your QBI is less than your taxable income minus capital gains. So remember, there's always some sort of limitation threshold. You know, this is going to be difficult to do by hand, but the tax software should really help you. Your K1 should give you the information you want. So it should happen pretty much automatically, but there's a lot of thought that needs to go into it. But remember, you're in a service business. Your income is low, you get the whole deduction. Once you get into the phase out range, you're losing some of it. For each dollar you get into the phase out range, and the wage and property limitation kicked in. So you got it's like a double-edged sword. If it's not an SSTB, like a manufacturing company, retail store, a restaurant, there is no income cap. You're not priced out. But there's always that wage and property limitation. They want to make sure that you're not just getting all the income yourself, that you have employees, your job creation. So the new law favors, that's why they call it a Tax Cut and Jobs Act. This wage limitation is incentivizing job creation. Now, if you're an investment manager, you might have wages paying yourself. If you're a trader, you might have wages paying yourself, and that counts too. The new law favors the non-service businesses because there's no income cap. You're not priced out of the deduction, but they have the W-2 wage and property limitations above the threshold. So everybody under 315, married, 157, 500, you're good to go on a deduction if you have taxable income. Once you get above the 315, the wage and property factors kick in. And that's it for a non-SSTB. There is no income cap, but for the service business, they cut you off at the income cap. Now that income cap, the phase out range, the taxable income threshold, they're going to be adjusted for inflation each year. Otherwise, it would be unfair. And that's good because we do have some inflation. Here's how the W-2 wage and property limitations apply. And you're probably saying to yourself already, Bob, This is extremely complicated with the thresholds, the limitations, the haircuts. If they wanted to give us something, why didn't they just give it to us? Why are they making us go through a maze and climb through hoops? Well, they're doing that because they don't want people gaming the system. They want it to be fair, but you're probably thinking, where's the tax simplification? What happened to that postcard tax return that some of the tax writers were talking about? Well, when it comes to this deduction, you can throw that out the window. It's complicated, and you're going to need probably a good tax advisor to help you through it. Now, you're probably not going to need to restructure a lot because you'll see later on in the anti-abuse measures and in the aggregation, there's other rules that kind of combine everything. So if you have great factors in one business, but not enough, like not enough wages in another, it's all consolidated. So I think they've put a lot of work into this. They have a lot more work to put into it, and hopefully it's here to stay for the long term, because why make everybody learn all this new stuff if it's not going to be here for the long term? So here's the wage and property limitations. It's 50% of wages for the qualified trader business. But you know, some businesses have a lot of labor and very little capital. Others have a lot of capital and very little labor, like with all the automation of factories. And they want to help factories here. So the alternative wage factor is 25% of wages, not 50% for the qualified trader business, plus 2.5% of the unadjusted basis immediately after acquisition of qualified property. So you got to see what's qualified property. It's not taking into account the depreciation. It's looking at the unadjusted basis. A lot of more complication, but fairness. And they threw in that property factor to help the real estate businesses last minute in the deliberations. I'm not done. There's other types of qualified business income, and this is noise to a lot of taxpayers. But open up your ears, traders and investors, because this is right up your alley. It includes rights, real estate investment trusts, and PTPs, publicly traded partnerships. So go over to the IRS site, their basic questions and answers on the 20% deduction. You can get this deck of slides with the links in the notes and click on that link, go over there. You'll see eligible taxpayers may also be entitled to a deduction of up to 20% of their combined qualified real estate investment trust dividends and qualified publicly traded partnership income. And this component of the deduction is not limited to wages and property. How would you do that with rights? It would get too confusing. And it applies for not just individuals, but trusts and estates. Now let's dig into traders. A lot of you here today are traders. You trade your own funds. And when all this was coming down with the discussions of tax reform and the proposed bills and the final law and now the proposed regulations, we've been on top of it all along. And you can look back at our prior blog posts. First, we had to see, are traders going to qualify for this deduction, and what income is going to qualify? So traders eligible for trader tax status, that's the linchpin. It's always been the linchpin for everything. You need trader tax status. They might, not definitely, they might get a 20% QBI deduction on 475, that's our other claim to fame, section 475, mark-to-market ordinary income, not capital gains, from securities trades, not futures trades, if they are under the taxable income cap, because it's a service business. TTS traders are a service business. That's clear. The proposed regulations confirm it, that TTS, a service business, is subject to the income cap. Right from the proposed regulations, quote unquote, trading, proposed 199A provides that any trade or business involving the performance of services that consist of trading means a trade or business of trading in securities, commodities, or partnership interests, whether a person is a trader or determined, taking into account relevant facts and circumstances. When they say performance of services, a lot of people get confused thinking, well, wait a second, I'm trading for myself. I'm not performing services for someone else. So they got a little confused, but look at the continuation of the regulations. Factors that have been considered relevant to determining whether a person is a trader include the source and type of profit generally sought from engaging in the activity, regardless whether the activity is being provided on behalf of customers or for a taxpayer's own account. Taxpayer's own account. And then they go on to mention the tax court cases, which a lot of our clients know: Endicott, Nelson, King. These are the trader tax court cases that I write about in the guide. A person that is a trader under these principles will be treated as performing the services for themselves. So the regulations cleared it up for anyone who had questions. I never had a question. Darren Nushran and we never had a question, but others did. So that's settled. Now, trading income included in QBI. The proposed regulations do not expressly answer this essential question. What types of trading income are included in qualified business income? Because after all, if it's not QBI, there's no deduction. The proposed regulations define a trading business. We just went through that. So I presume tax writers contemplated some types of income might be included in QBI. Why would they say that a trading business is included if it was impossible for a trading business to have qualified business income? Now, right from the start of the new law, QBI excludes capital gains and losses expressly, quote unquote, capital gain or loss, dividends, interest income other than interest income properly allocated to a trader business, amounts received from an annuity other than in connection with the trader business, certain items described in section 954. That's some foreign source income stuff. Why they went that route of explaining it, it's a little confusing, but when you dissect it and look at the regs, it's clear what they're talking about is 954 transactions in commodities, foreign currencies, and notional principal contracts. The latter two of those are ordinary income. So I was thinking maybe we can get those in QBI. But because I think they're expressly listed as excluded from QBI, I want to take the position that they're excluded from QBI. Now, what's the odd man out here? The regulations do not expressly exclude or include Section 475 ordinary income on securities trades in QBI. So I've done a lot of work to lay out the rationale for why you include 475. Now the regs went in that direction. They tackled Section 1231, and I want them to tackle 475 in the final regs. And you'll see I've been in communication with the Chief Counsel's office on it. I'm going to cover that shortly. But they tackled 1231. That's when you sell your depreciable real property. This is a little in the weeds, so try to stick with me, traders. I know there's also tax advisors on the call. They'll find it a little more palatable, but stick with me, traders. I'm getting down to the big picture for you guys. But this part's a little bit in the weeds. 1231 is business property. So they say that if it's treated as capital gains, so if it's a gain, it's long-term capital gains. They're saying, well, that's excluded because it's a capital gain. But if you take a loss on the sale of business property, no, wait a second, that's not from the sale of a capital asset. That's ordinary income, and that's included in QBI. They just laid out a rationale for how ordinary income in 1231 is QBI, but capital gains in 1231 is not QBI. Okay. If you overlay Section 475 on top of the above wording for 1231, there is a similar result. Section 475 ordinary income is not from the sale of a capital asset. It should be included in QBI. Now, ordinary income is defined in the tax code, not business income, but ordinary income is defined in the tax code, and Section 475 also talks about it. The term ordinary income includes any gain from the sale or exchange of property which is neither a capital asset nor described in 1231B. They're talking about the long-term capital gain that I just mentioned. Any gain from the sale or exchange of property which is treated or considered under other provisions as ordinary, 475 says it's ordinary, it shall be treated as gain from the sale or exchange of property which is neither a capital asset nor described in 1231B. Bingo. This is a red carpet ushering in 475 to QBI. If it's ordinary income from a business activity, trader tax status is section 162 business activity, and it's not expressly excluded from QBI, which it's not, then it should be included. If you search the code or the regs, just search section 475. It comes up 20 times, but always talking about what is a trader, never in the context that it should be excluded from QBI. So it should be included on securities in QBI. Now, I wanted to get some comfort from the IRS Chief Counsel's office, and I called them to ask about it. And they didn't call me back. They're not going to call back everyone. Some of our tax attorneys, we know some of the branch managers and chief counsels in the different divisions, financial products and other areas, but not necessarily for these for pass-throughs and for this area. So sure enough, I get interviewed in Tax Notes, which is a major tax publication and widely read, about this issue. Click on the interview link there to read the interview, making my case that I'm making to you right now. And bingo, the next day I get a call from the Chief Counsel's office saying, hey, I read your Tax Notes interview, and then I remembered you had called me, and let's talk about it. And I went through the whole pitch that I'm giving you now. That attorney told me my rationale for including section 475 ordinary income on securities in QBI sounded quote unquote plausible in his opinion, but he asked me to provide an example to include in the final regulations. And the following examples I'm going to show you, I think could be the ones I give him, which I'll do probably tomorrow. And he wants to wait for the final regulations. He's giving me his personal opinion, but he said it sounded plausible. That means a lot to me. That's a good way to getting where we need to go. Example one, a trader with ordinary income. So wake up if you got lost in the weeds a little bit. Here's a concrete example for a trader. A lot of our clients have trader tax status and they have a 475 election. Why do they have 475? Because it's been incredible tax loss insurance. It's turned their losses into gold. They went from no deductions of losses or puny deductions, the 3,000 capital loss limitation, into huge ordinary losses and big tax refunds, tax loss insurance. We've advocated for over 20 years since they brought it into the law for traders in 1997. Well, now the new law gives a nice tax benefit for 475 income, making it even more exciting for traders. So a securities trader filing single, let's take out the complication of married, they have trader tax status, and they have QBI of $100,000 from 475 ordinary income. So their trading gains were $120,000 minus their trading business expenses of $20,000. Their net QBI $100,000. His taxable income, this trader, his or her, minus net capital gains is $80,000. So basically, the only income he has is QBI. But he's got the standard deduction of $12,000. He's got some other losses. His taxable income is $80,000. So remember, it was the lower of. He is under the SSTB taxable income threshold of $157,500. He didn't price himself out of the deduction. He didn't make more than $157,500 for single. So there is no phase out of the deduction. There are no W-2 wage and property limitations to apply. It's pretty simple. So what is his deduction? Is it 20% of the $100,000, $20,000, or is it 20% of the lower taxable income minus capital gains? Well, that's exactly what it is. It's $16,000, 20% of the $80,000, since the taxable income minus net capital gains is $80,000, and that's lower than the QBI of 100. Now, let's take that example one and switch it up a bit. Say if his taxable income is greater than 157,500, same trading income, but he has a job, and the job income took him over the threshold, but he's less than the income cap. So you remember, for single, the phase out is 50,000 between 157,500 and 207,500. So he's in the phase out. So what does that tell you? Well, it tells you he's got to phase out the QBI deduction, and he's got to start to apply the wage and property limitations inside the phase out range. And we'll go through some examples of that later. Now, let's say his taxable income is higher than the income cap. He's got a big W-2 job. And that's not a W-2 job from working for another company is not a wage factor. So he's got a big job and he's priced out of the deduction. Don't worry about this whole exercise. You don't qualify for the deduction. You're priced out of it. Now, again, let's give an example, talk about the wage limitation for traders. TTS traders, like how would you have a wage limitation as a trader? This is how. TTS, trader tax status traders. They know with all our content that we have them using an S-corporation, single member LLC S-Corp, spousal member LLC S-Corp. Why the S-Corp? Because the S-Corp unlocks the health insurance and retirement plan deductions in connection with officer compensation. So your sole proprietor, your partnership trader, they don't have earned income, they can't unlock the health insurance and retirement. Now, if that trader happens to be in the phase out range, they're going to need the wages for the wage limitation. So they need wages for the wage limitation. Well, I just said they already have wages for the health insurance and retirement plan deduction. So these two strategies dovetail nicely. The TTS trader can determine wages that maximize tax savings. This is something our clients are going to do with us in December, because that's when we figure out how much are the wages, how much you want to contribute to the solo retirement plan. We need wages for the health insurance portion. And now on top of that, we're going to do the QBI planning too. Why not get that extra $10,000 or $20,000 deduction? That way more than pays for our fees and puts a lot of money in your pocket. All right, let's pivot from the trader trading his own funds to hedge funds. Now, you may be an investment manager, a hedge fund entrepreneur, or you may be a trader that also invests in hedge funds, or you just may be a hedge fund investor. If you own an interest in a hedge fund, you might get a QBI deduction. Investors in hedge funds that are eligible for trader tax status, remember that's always the linchpin when it comes to anything green trader tax. They might get a 20% QBI deduction. Remember, QBI got to be 475 ordinary income from securities trades. And again, if they're under the service business income cap. So it's very similar to the trader. Remember that the trader in a hedge fund brings the trader tax status to the hedge fund. The hedge fund elects 475, and then all investors can get this QBI deduction if they're under the income cap. Now that tax notes publication, the quotes from Robert A. Greene, remember I mentioned that before, that's why the chief counsel called me back. And these are some of the quotes. Before the proposed regulations were released, this is a quote from me. Some other tax experts argued that a hedge fund wouldn't be a barred service activity. He thought it opened the floodgates to hedge funds, and he was actually criticizing the law for doing so. But I said, wait, so he was saying that all hedge funds, they're not providing a service. The management company is providing the service, and the hedge fund is merely receiving it. And I said to him, wait a second, to claim trader tax status, these are quotes, and elect Section 475, a hedge fund partner must do the trading, not an outside manager. Typically, a management company would be a partner in a hedge fund and would be trading for the fund. So that hedge fund has a the manager, who's a partner, who's bringing trader tax status to the hedge fund level, which opens the door to a 475 election. So the hedge fund can't say that it's not trading for its own account. It is trading for its own account. And the regs were clear about that in other parts of the regs than the parts I just explained to you earlier. So I think it's unequivocal. The regs make it clear that a hedge fund is a SSTB. So the hedge fund with TTS can elect 475. A hedge fund that qualifies for trader tax status is entitled to elect Section 475 ordinary income or loss treatment on securities and or commodities, meaning 1256 contracts. Section 475 ordinary income or loss on securities is likely included. Remember, it's 475 on securities, not 475 on commodities. The taxable income thresholds and the SSTB, the service business income cap, apply. And this is the key point. It applies to each investor in the hedge fund. Some investors who won't be priced out, they may get a QBI deduction. They may not be upper income. They may be wealthy, but not have upper income. They may be accredited investors, but not have upper income, whereas others may not, depending on their taxable income, QBI aggregation, and more. So some get it, some don't. So every pass-through entity needs to put in place, what is a QBI? Put it on the K1. Is it a service business or not? What are the wage factors? Each pass-through business needs to provide the owners this information, because some owners will qualify and some won't. Now, here are some 475 election considerations for you hedge fund people on the call. Before 2018, many hedge funds did not elect 475. Whereas our retail trader clients definitely elected it. They wanted the tax loss insurance. They were day traders, swing traders. But I noticed a lot of hedge funds weren't electing, and I was wondering why. And it's because they didn't want to use mark-to-market accounting. That causes investors to owe taxes on unrealized trading gains. So they would buy a position, let the profits run, and they would morph it from a trading position into an investment position, which really still means that it's a trading position for purposes of 475. And they didn't want to have to pick up an unrealized gain at year end, because the investors might request cash distributions to pay those taxes, which could cause liquidity problems. Now, with the advent of the 20% QBI deduction for non-upper income hedge fund investors, it changes the calculus for managers to consider trader tax status in a 475 election and how they work their carried interest provisions. So it requires a new look. Take a look at my other blog post, New Tax Law Favors Hedge Funds Over Managed Accounts, where I go into all this carried interest provision planning and strategies in light of the new law. Now remember, if you want to elect 475, an existing taxpayer for 2018, they had to elect it by March 15th with the IRS. Prior year election applies for subsequent years. If you made the election for 2018, the second step is to file the change of accounting method on Form 3115. If you're a new taxpayer, a new hedge fund now, you can elect 475 within 75 days of inception. Now, 475 applies to securities and commodities, and or. Most of our clients elected on securities only, but you can elect it on both. And there could be a rationale if you had a large loss that you wanted ordinary loss treatment for on commodities. So if you're eligible for trader tax status, you can elect it on one or the other or both. Most trading companies elect it on securities only so that they can retain the lower 60/40 capital gains rates on 1256 contracts, commodities futures, or for example. 60% is a long-term capital gain, even on a swing trade, and 40% is short-term. The long-term rates are lower. The blended rate is like 1/3 off. The QBI regs, again, exclude commodity transactions, so 475 election on commodities is likely excluded from QBI. Let's do an example for hedge fund investor. All right, so if you ever get lost in the weeds here, always open your ears for the example. This will crystallize it for you. And each one of my examples kind of touches on a little bit of a different area of this new law to feature it. Because if I try to feature every little twist in one example, I could lose you. So in this case, we have married taxpayers. They invest in a hedge fund. They're not traders. They're well-to-do. They have good jobs. They invest in a hedge fund, which happens to have trader tax status. Most hedge funds don't, but this hedge fund happens to have trader tax status, and it elected 475 on securities. Their 2018 Schedule K1 that they got from this hedge fund, it lists QBI of $100,000. They show it to their accountant and said, hey, this shows $100,000. Can we get a $20,000 deduction? And their accountant says, I don't know. Let me check with Bob Green's PowerPoint deck. I'm just kidding. The couple's taxable income is $355,000. So this is what the accountant's trying to figure out. And the net capital gains are $25,000. All right, so what does that tell them? Well, the QBI of $100,000 is less than taxable income minus net capital gains. So the QBI deduction is based on QBI. So again, the client is saying, I want a $20,000 deduction. Make this happen for me. So then the accountant works a little bit more. Well, the couple's taxable income is $40,000 above the threshold of $315,000. It was $355,000. It's $40,000 above. But it's below the service income cap of $415,000. So it's into the phase out range. It's how much is it into it? It's $40,000 into $100,000. It's 40% into the $100,000 phase out range. So they're going to lose 40% of the QBI deduction. Okay. They want the other 60% of that $20,000. They'll take that. They're not dissuaded. Keep working, accountant. I want my QBI deduction. All right, well, now we got to look at the wage and property limitation because we're in the phase out range. The wage and property limitation applies since the couple is in the phase out range. The 50% wage limitation is zero because the hedge fund does not have payroll. The management company does have payroll, not the hedge fund. All right, what about the alternative wage limitation, the 25% wage plus 2.5% property limitation? Will that get me anywhere? No, it doesn't. That's also zero because trading capital does not count as property. The hedge fund doesn't have any property. The management company has the computers and property. Now, you're not out of luck, client. Don't let your accountant who doesn't understand this tell you, skip it. Don't skip it. You got to go further. This is where the regulations actually are your friend. The aggregation rules, unless the couple has another source of QBI, because remember, you're consolidating it. That other QBI that you could have might have excess wage and property limitations. So you might wind up getting a QBI deduction in connection with this hedge fund investment under the aggregation rules, which I cover later. So don't give up. Like with trader tax status, don't 475. Don't let an accountant who doesn't understand the nuances of something, how it applies to your peculiar facts and circumstances, and trading is peculiar for most accountants. Don't let them give up on this. Get what you're entitled to. Now let's talk about investment managers. These are, you are trading for other people, whether it's a separately managed account or through a hedge fund. You're giving investment advice. You're getting compensated. That's investment management. It's a service. It's a service. They are SSTB, service businesses. And their QBI, it includes advisory fees from U.S. clients. And it also likely comprises carried interest of 475 ordinary income from trading securities. Investment managers or SSTBs. There was some confusion on that in the code, but it's cleared up in the regulations. The proposed regulations describe specifically investing and investment management as SSTBs subject to the income cap on a QBI deduction. QBI includes management fees and incentive fees on separately managed accounts, management fees from hedge funds, earned from U.S. clients, not foreign clients. It's domestic QBI, so it must be from domestic sources. QBI excludes a carried interest share, profit allocation of capital gains. That's that carried interest provision that was a hot potato whenever tax reform came up, where Warren Buffett's secretary paid a higher tax rate than he did because he got carried interest, or hedge fund managers, they got a share of long-term capital gains rather than ordinary income. That survived tax reform. There were some modifications. The manager has to wait 3 years to get the carried interest, that long-term capital gain. But anyway, it's a profit allocation. It's a K1 allocation of capital gains, even short-term capital gains. Well, if it's an allocation of capital gains, that's excluded from QBI, folks. But if it's a carried interest share of 475 income on securities, I make a case for it to be included. Now, investment managers are likely going to have the wage and property limitation. Normally, investment managers, they often choose an S-Corp structure to reduce payroll taxes. The 12.4% FICA up to the base amount of $128,400 goes up to $135,018. And the 2.9% Medicare portion, and there's also a 0.9% surtax on top of that. So they want to, if an investment manager is a sole proprietor, which you don't want to be, you want liability protection, or if you have a LLC partnership, it's all underlying earned income and you're paying maximum FICA and Medicare. So you use the S-Corp to reduce it. But the IRS requires reasonable compensation for officer owners. Okay, you got your officer compensation. That's your wage factor. So you're already halfway there. Having payroll is helpful for generating a larger QBI deduction if the owner is in the phase-out range. Remember, over the income cap, forget about it, you're out of luck. But you're in the phase-out range, the wage factor applies, you got some wages. Plus, investment managers have some office equipment. They may have a property factor, but it's probably not significant. Let's look at an example for investment managers. You got your S-Corp investment management business. It pays the 100% owner, your single member LLC S-Corp, pays officer compensation of $50,000 on a W-2, and the net income after is $150,000. So the net income before was $200,000. You took 25% of net income for reasonable compensation, $50,000. The other $150,000 was free of the payroll tax. You saved a lot of payroll tax doing that 25% reasonable compensation. How does this work out for the QBI deduction? Well, all your advisory fee revenues are from U.S. clients. You don't have any foreign clients, so it's all 100% QBI. The owner is single. His taxable income is $177,500. Well, bingo, he's in the phase-out range under the income cap. He's between the $157,500 and the $207,500. He has no capital gains or losses, so we don't have to confuse things with that. His QBI is less than taxable income minus capital gains because he has some other types of income, maybe wages from some other business. Also because he took some of his QBI and converted it to wages. That's the reason it's less. He took some of his QBI and converted it to wages. So he calculates QBI deduction on QBI. How does it work with the limitation? This is where it all comes in and it can get more confusing. So I'm going to go through it, but go back and look at the slides later. The owner is $20,000 above the threshold. He's over the 157.5. He's into the phase-out range. How much is he over? He's 40% over. So he's going to lose 40% of his deduction. But how much more is he going to lose because of the wage limitation, if at all? Well, his 50% wage limitation is $25,000 because his wages were $50,000. Remember, his reasonable compensation was $50,000. 50% of that is $25,000. That's pretty good. $25,000 is the wage limitation. His potential QBI deduction, that was $30,000. because his QBI was 150. Remember, his income was 250,000 wages, 150 net income, the QBI. So he could have gotten a deduction of 30, but he's limited to 25. He'll take that. His alternative property limitation is lower. He doesn't have much property. So the owner's QBI deduction is probably, this is a little rough way to calculate it on this slide. It could be a little trickier in the final regulations, but so don't hold me exactly to it. But this is how it makes sense, that 60% was phased out. No, excuse me, 40% was phased out. So he gets 60% of the remaining range. And the wage limitation was 25,000. So you take 60% times 25,000 and his QBI deduction is 15,000. It wasn't 30, which was 20% of his QBI. It's 15. It's half of that because of the wage limitation of 50%. That's one way to look at it. That's not actually just worked out that way. So the bottom line is this manager gets a $15,000 deduction from taxable income. If he's in a 50% tax bracket or 40% federal and state tax bracket, that's a lot of savings, folks. So $6,000, he'll take it. It's worth the trouble. Now, we covered the trader, we covered the hedge fund, we covered the investment manager, but a lot of you on the call also have other businesses. You're an IT consultant, you're a lawyer, you have other business activities. You attended today. You don't want to just know about traders. You also want to know about the big picture with QBI. The proposed regulations narrow the definition of service businesses. That's good news because remember, the service business has the income cap. This will open the door to more QBI deductions for people who are not SSTB businesses and otherwise would be priced out. So the specified service trades or business, the definition, any trade or business involving the performance of services. A lot of people perform services. Okay. In the fields of health, law, accounting, actuarial science, performing arts, not painters, performing arts, consulting, broad area consulting, athletics, financial services, broad area financial services, brokerage services, broad area. Any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its owners. A famous hedge fund is known for its reputation and skill, but the regulations say no, it's not the famous hedge fund. It's very few people fall under that catch-all provision. We're going to cover that shortly. And two, in case you didn't realize it, they made it crystal clear, and this is our area, trade or business that involves the performance of services that consist of investing, investment managers, and investment management, trading, or dealing in securities. And they went out of their way to say trading on your own account. So, all right, when they were negotiating this, originally they had engineering and architecture in the fields of services. But there was a backlash, blowback, and they carved out engineering and architecture. After all, engineers help build bridges, and they want infrastructure, they want manufacturing. They safeguarded, hardware engineering. Does it include software engineering? I haven't actually looked at that close. You have to look at that a little bit more. The proposed regulations exempted some types of service businesses, not in all cases, but they went out of the way to say real estate agents and brokers, you're not service business. Insurance agents and brokers, you're not service. Property managers, you're not service. If you're a classic banker, you're not a financial service. If you take deposits and make loans, you're not a service. So they're trying to trim the sails because they want this provision to apply to more people. There's more people complaining, the lobbyists talking to the tax writers about it. And also a lot of this stuff makes common sense. Now they focused on SSTBs on professional services. For example, you're involved in the healthcare industry. You sell medical equipment. You service medical equipment. You're not a doctor. You're not a nurse. It's not an SSTB. So but physician healthcare services are. This is still going to be hotly debated into the final regulations, there'll be tax court cases. There will be a lot of fighting over this, folks. Performing artists are not SSTB, but the people who put on their performances and maintain and operate the equipment and facilities, they're not performing artist services. So again, there's some good news there. Let me, what's going on here, Mike? 1 second. Sorry, folks. We had a little freeze there. Okay, so it's nice that they narrowed the definition of the service businesses so more people don't have to have the income cap and they won't be priced out. They'll need a wage and property factor. They'll probably have it somewhere on a consolidated basis and get something. Now, it is good that the proposed regulations narrow the definition of reputation and skill of the owner. The updated definition is it's for endorsing products, licensing an individual's image, a likeness, name, signature, voice, trademark, receiving appearance fees. These are the true celebrities. It's, appearing on television, social media, forum. These are the true celebrities. It's not for the famous hedge fund manager, the famous chef. It's not for that person. Now, there are anti-abuse measures. There's always anti-abuse measures because there's one accountant writes the law, the next accountant and tax lawyer comes by. How do you skirt the law? It's a game of whack-a-mole. Excuse me for using that term in connection with esteemed tax advisors. But there are corporate type people who they look for every loophole. I don't think that that's a winning game myself, but they do it. Anyway, when the code came out, a lot of people started doing all these schemes thinking they could abuse the system. I never said to do those schemes because I knew that they're going to have anti-abuse measures. They said that they would. You can't do cracking and packing schemes. The proposed regulations prevent cracking and packing, where the SSTB might contemplate spinning off SSTBs to achieve a QBI deduction. You're an accounting firm, you're a law firm, you're a doctor's office. You say, listen, we happen to own our building. We happen to have all this other, laboratories. Doctors have these labs. We're just going to spin those off into separate companies so that we consolidate our SSTB income because we're priced out of it, or we're wealthy, upper income doctors or lawyers, and we'll get the deduction by spinning off. Well, the proposed regulation said that if the SSTB includes any trade or business with 50% or more common ownership, directly or indirectly, meaning attribution rules apply, that provides 80% or more of its property or services to an SSTB. Additionally, if a trade or business has 50% or more common ownership with an and the extent, and it provides property or services, the portion of that is treated as SSTB. Go back and read the definition. Bottom line here, your accounting firm spins off your medical practice spins off the office building. And then you rent all the space in that building, or most of the space. You're not going to get non-SSTB income. These rules are going to rein it in. Now, there are ways to achieve it, but you can't own more than 50%. You have to share the building with someone else. So there are ways to do it, but it's going to require giving up some of the ownership, giving up some of the control. It may not be what you want. You may go through a lot of trouble of restructuring and still wind up with little deduction. So think twice about cracking and packing. Think twice about changing your status from an employee to an independent contractor. You work for a company now. You say, I'm quitting. I'm setting up my own S-Corp. Pay me as an S-Corp contractor. Save some payroll taxes. It's in your interest too. You don't have to pay my health insurance anymore. Well, it won't work, because your ex-employer is your client. So read the rules. You can do some of these things, but you have to do it in a way that works and have a lot of other clients as an independent contractor. I'm not covering all the rules today. There's a lot to it. I'm focusing. This is what I do. I take law, tax law, and I focus it on the needs of our clients, our niche, because the mainstream media talks about the big picture. And people get lost in the weeds on that. They need me to break it down on how it works for them as a trader, hedge fund, or investment manager. So these are good rules: aggregation, allocation. QBI losses are not so good. The regs allow business owners to aggregate. Why are they letting you aggregate these things? It comes in handy for leveling out the wage and property limitation factors. One business doesn't have any wages or property. That hedge fund before, remember, it didn't have any factors. You were in the phase out range. You needed those factors. Your other QBI business had plenty of those factors. So you don't need to restructure the business to say, oh, I need some wages on my hedge fund and less wages in the other one. You don't need to go about all that. You can aggregate and allocate. QBI losses. If you have a big loss, the IRS doesn't want you to say, well, forget about that loss. Just look at this income. You got to apply the losses on a consolidated basis. And if you have excess losses in one year, you got to carry it over to a subsequent year. You love that net operating loss and all carryovers because that reduces tax. You don't love QBI loss carryovers, but you got to do it. And it's pretty confusing, but we're hoping the software is going to do a good job of handling all this for everyone. Forget that postcard return, folks, if you're involved with any pass-through entity. Again, the postcard return, it's a shorter 1040, but there's all sorts of sub-schedules and forms. So it's a little disingenuous to, yes, they suspended a lot of your investment deductions. They just flat out suspended them. Did that make it a simple tax return? No, it didn't necessarily do that because some of those suspended deductions you still need for other places of your tax return, like the net investment tax. Little editorial there, sorry folks. Okay, so the QBI loss application does not affect other tax matters. So you had a big loss this year, going to carry it over to next year, you might wipe out your QBI. We're getting close to the end here, so we get to the questions, folks. We're a few minutes over, but that's doing pretty good. I knew we had a lot of content today. Where do we stand? We have proposed regulations. Normally, your accountant says to you, well, I don't know, can we rely on that or not? These are proposed reliance regulations. The taxpayers, stated taxpayers, are entitled to rely on them pending finalization. Now, I hope they finalize soon. They have a public hearing coming up. I hope they finalize soon. Why? The pressure is on. The 2017 Tax Cuts and Jobs Act was a significant piece of legislation. I presume the IRS will attempt to issue final regulations in time for the 2018 tax filing season, which starts in January 2019. Tax planning starts now. We're working with clients. They're still setting up Q4 entities. They're going to want to do their payroll in December through the S-Corp. We need answers now. The IRS needs to produce tax forms for the 2018 QBI deduction. The K1s, the 1040, the deduction form itself. It's best accomplished after finalization of the regs. The tax software makers are scurrying about. They need time to program this all into the rules to make it easier for, if you self-prepare with tax software, if you use a good CPA using more professional software, it's all got to be baked into the cake. So again, if you're just an employee, the new tax law did reduce your tax compliance. It suspended many of your itemized deductions. You're going to be up in arms when you realize that that's state and local, the SALT limitation. You're going to be up in arms that things have changed for you. So you still it may not be an easy tax season for you because you're going to do things differently. But it's not a postcard return. And again, this new law for the proposed regulations of the 20% QBI deduction, it's very complicated. You want to work with someone who really understands the law. and understands how it applies to your business. They know cold. Is your business a service business or not? Plain and simple. What is the QBI in your business? Plain and simple. Accounting is becoming more niche oriented, like medicine. You need to work with a CPA and tax advisors who understand your industry, trading, hedge funds, investment management, and other niches that you may be involved with. All right, so we're going to get to your questions on the board now. So come over to the GreenTraderTax.com website. There are blog posts, webinar recordings, a lot of information about these topics on the tax reform. Give us a call, 888-558-5257, or chat and phone resources are really tied up now. The partnership and S-Corp tax returns for 2017, the tax deadline is September 15th, days from now. That's the date for the Q3 estimates for individuals. The individual tax deadline for extended returns is October 15th. So our tax compliance team is tied up. We're not doing new client evaluations for 2018 until after October 15th. So email us at info@. You may hear back directly from me. I'm not on the tax compliance team. I do the consultations, the entity formations. You can do all that with me. You can do the trade accounting, but the tax compliance CPAs are tied up with 2017 now. But all of the rest of October, November, December is focused on the year-end tax planning. So come over to the website and let's bring up the website here. And I'm going to get to your questions now. So remember, you can read a blog post about stuff we just talked about today, but I think that this PowerPoint deck is even better because I start my decks from the blog post and then I add to it. So get that deck later on. So you would go over to events here on the right here, and you would bring up events. You'll see we've got the Traders Expo coming up, but you would come up to this event, and later today, the recording will be posted here, and it will be on the Interactive Brokers website as well. And you'll get, the ones who attended or registered will get a direct link to the recording. So let's look at your questions. And here's the contact us page, by the way. All right, so we'll get to questions now. Keep them brief. I'm opening those up. Okay, when you see my cursor moving, that's because I'm moving around the questions here. So this is from EN. I'm going to give initials only to protect people's names. And let me just drink something. Where does trading with a firm like Top Step Trader put us in relation to QBI? I believe you're talking about a proprietary trading firm, and I could have added that to the slide deck. It was probably an oversight. Prop traders, an area we cover as well, they fit right in nicely between a trader and a hedge fund. I mean, the proprietary trading firm is an LLC with K1s. It has trader tax status. It almost always elects 475, and you're a prop trader in the prop trading firm getting a K1. So yes, you're going to get QBI. You're going to have QBI from the 475, but probably no wage or property factor. So you're going to be like the hedge fund investor, where you might have if you're in the phase out range, you'll have the wages from other QBI activities, or if you're under the income cap, presto, you'll get your QBI deduction. So your prop trader LLC member gets a QBI deduction, and the prop trader independent contractor, which you might be with Top Step Trader, where you get a 1099 miscellaneous, that's like the investment manager getting advisory fee income, consulting fee income. That is a service business. The income cap applies, and that fee income you get on the 1099 miscellaneous is QBI. So that's the answer for the prop trader. Jim T, would QBI include futures contracts? No, I think the QBI excludes the commodity transactions. Come over to the blog post. This is where there's a difference now between the blog post and the webinar. So you want to consume both the content. You always want to consume the blog post and the content. So you would scroll down to that blog post, and I want to show you how this came about. And it's also on Forbes. My blog posts are always on Forbes. But you see where this is where it backed out the 954 transactions. And this 954 transaction right here, it said transactions in commodities, excess foreign currency gains. So I thought that, hey, that sounds like it's backing out 1256 contracts futures because they get 60/40, they're getting another tax benefit. So the way I read the law, it backs out the commodity transactions. Let me bring back the control panel here. Bring up the questions again. All right, so the next question from Charlie T. Can you please clarify the income cap? That's for service businesses only. Everybody's got the threshold. That's the lower number. The 315 married is the lower number. Then there's the phase out range of 100. Then the 415 income cap. The income cap is only for the service businesses. There is no income cap for the non-service. So 315 is the threshold, because below the threshold, everybody's good to go on everything. There's no wage or property limitation. You're good to go if you're under the 315 married, 157 other taxpayers. And you may want to file separately to achieve this deduction because the other penalties aren't there. So your accountant is going to run the numbers both ways in the software. So the 315 income is the threshold, taxable income threshold. The 100,000 is the phase out range. This is for married, and the 415 is the married income cap. All right. Matthew A. When you refer to commodities, do you mean 1256 contracts? Yes, that's part of commodities, but it can be broader, like foreign futures. Are there traders excluded from the deduction? Yeah, so if you're a futures trader, you're going to be excluded from QBI. I would like to see the final regs. I would like to have them look at more of my examples, but that's the way our interpretation to date. Aaron S. Can payment in lieu of dividends that are reported on 10A? Well, payments in lieu of dividends sound like dividends to me, and dividends are excluded. So it's probably excluded from QBI. That's not 475 ordinary income, but I'll take another closer look at that. And again, we're waiting for final regulations that deal with more things, but I need to get more of these questions into the chief counsel's office for them to address these more in examples. So bring on your questions to me by email. Doesn't mean I'm going to give you a full email answer, but I'm going to put it into my knowledge base to go to the chief counsel's office with. Andrew S. Sounds like 1256 contracts are not eligible for QBI, right? Chris M. But you're getting 60/40, which is a beautiful thing. And those lower tax rates, the blended rates, are on our website. Chris M. Non-upper income hedge fund investor. What is the definition of this? Well, hedge fund is SSTB. If you have QBI from 475, good. But if your income is over the income cap, you're not getting any QBI deduction for service activity QBI. So you don't need to go through the maze. You know you're not going to get anywhere. Scott L. Pass-through, quote unquote. Does this QBI deduction only apply to individual traders with an entity? Any individual, estate or trust that has QBI reported to them could get a QBI deduction providing they meet these thresholds and other factors. So a lot of people need to deal with QBI deductions on the individual level. You may think, hey, I'm not an entrepreneur. I don't have my own business, but you've invested in your brother-in-law's pizza shop. You're invested in a hedge fund. You're in a prop trading firm. You have REIT dividends. You have publicly traded partnership income. You might have QBI and not know it. And you may get a deduction and not know it. And it's a shame to leave money on the table. It really is a shame. And it's a shame if they make it too hard for you to get this deduction, if they rule too many people out. They're trying to find the right balance. It's not easy, folks. And when they got involved with this in the tax cuts, I knew that this was going to be a very challenging area. and an employment act for accountants again. It wasn't putting accountants out of business with postcard tax returns, because a lot of America is involved with pass-throughs. We're an entrepreneurial nation. Venture capital, private equity funds. I mean, there's a lot of this going on. And if you're a C Corp, it's not any easier. The new laws for C Corps are incredibly complicated. And C Corps are not good for hedge funds. They're not good for traders. We don't think they're that good for most investment managers. I have blog posts about that. Go to the website about it. So Scott L was saying, I'm an individual 475 trader as a sole proprietor. Would it work for me? Well, when the law first came out, we thought that if you have a partnership or S-Corp trading business, that it's going to look very good on the K1 to have ordinary income 475 beat QBI. Technically, I think a sole proprietor trader with 475 should be eligible for the QBI deduction. We were just concerned, particularly my partner Darren Neuschwander, that the IRS may find it more challenging to get that into QBI calculations. Okay, it's more challenging. What does that mean to Bob Green? It doesn't mean give up. It means we're still going to try for it. We think maybe an entity would be better for you, Scott L., but maybe that's not enough of a reason to form an entity, and we're still going to go for the deduction for you as a sole proprietor. We're not going to give up on it because we think it meets the letter of the law. So what does this all mean to you, folks? It means this is new law. There are new proposed regulations. There'll be final regulations. Remember what happened with the net investment tax, the Obamacare net investment tax at 3.8%? It really hurt traders with 475. I cried wolf, not wolf. I mean, I cried bona fide problems out. I had a Rally Congress petition. We brought down a lot of pressure on legislators and the IRS. We said this is completely unfair to traders in 475. What happened? We turned it around. They changed the regulations. The final regulations where traders went from being the worst to the best. So this is a process. It's a long-term debate and fight. And I need you all to support us, to bring questions to us. When I say there's a call to action, to follow up on it. We need brokers to help us with that as well. We don't have the fancy lobbyists like the biggest brokerage firms. So let's make sure these laws are fair to traders and you get your fair shake. Again, a little editorializing there, folks. Sarah L. J, and we'll wrap up. A hard break by 1:30. If choosing 1256 for forex, well, forex, I think if you go back to that 954 list on the blog, it said forex transactions. So if you make the 1256G election to get 6040, well, you're out for 1256G, but I think you were out for 988 anyway. My original blog post, I thought 988 could be included because it had ordinary income. I was turning on the phrase ordinary income. But if you look at this blog post, let's go back to it. The latter two items of these 954, and I explained it in the blog post, I forget exactly where, they're ordinary income, but I didn't think that they had the QBI right here, this paragraph. 954 is for foreign-based company income. Why the heck did they bring that into play? And I think the tax writers used it for convenience sake to define excluded items, including transactions in commodities, foreign currencies, that's forex, and notional principal contracts, those are your swaps. Now, forex and swaps by default are ordinary income. Should that be included in QBI? I was hoping it would, but I think a fair reading of this 954 mention here, and this is in the proposed regs, I think it's fair to assume it's excluded. That's why I did that. Let's go back to the questions. You see the cursor moving around. That's my control panel. Ina W. Can I deduct price to subscription service? All right, you're a trader, you deduct your trading business expenses. You're an investor, you don't get any investment expenses. go over to the blog post about, and let me show you again that blog post, folks. That recent one, the new tax law favors hedge funds over managed accounts. That really went through how you don't get the deduction for investors, how trader tax status does, and it referenced some of my other blog posts, how to avoid in the family office. So read all that content to get investment fees are not deductible, but borrow fees are. Read all those blog posts for answers on all those questions. 1 second. Bring back the questions again. I'm not going to go to second questions. Let me get the other ones who didn't do, but so someone's asking about SALT and phase 2 of the tax bill. Phase 2 tax reform 2.0 doesn't change SALT. And there were some SALT workarounds at the blue states that wanted to come up with the Democratic states, the high tax states. They had came up with some schemes. I said all along they were working on some schemes, but I didn't know if they sounded like that they were going to work. Then Treasury said, Mnuchin, Secretary Mnuchin, hey, you can't do these workarounds. We're not going to go for it. There's still some debate about doing it through a business. It's not the end of this. There are lawsuits. This will affect the midterm elections. This SALT thing is salt in the wounds. When you go to do your 2018 tax return and you're in a high tax state, you got a lot of real estate taxes, you're going to be upset about losing that deduction. And you're going to let your legislator hear about it big time. I mean, if they could have made it simple, they didn't necessarily have to flatten that out. That's a highly contested area, and the fight is not over there. But there has been reiteration of the limitation. So get ready for the limitation in 2018. Is it enough to move to a non-tax state or a lower tax state? I don't know. A lot of multiple questions, folks. Bring your questions on to me. I'm going to look at some of the ones that haven't asked questions yet, and then I'll circle back. Norman G. If you have a new biz as a trader but missed the 75 days, well, if you have a new entity and you missed the 475, you're out of luck this year, but we can elect it for next year. So you have an existing entity, you're an existing sole prop. That 475 election was due earlier in the year. You have a new entity, you have 75 days from inception. So yeah, you might have missed the boat for this year. You'll do it for next year. You'll see how the dominoes fall out this year anyway. Chelsea S. Can a licensed financial advisor taking 1099 personal SSN big brokerage take 20? Yeah, so you're an investment advisor. You have a Schedule C. You make 100,000 net income. You have wages. Your QBI deduction is based on QBI, which is lower than taxable income. You might end up with $20,000 deduction on $100,000 of income. You don't have any cash outlay, just a $20,000 deduction. You're going to be very happy. Warren S. But on the other hand, by the way, if you make too much money, you lose the deduction. Should you give up some clients to make too little? That's always a big mistake. The phase out range is there to dissuade you from giving up income, turning your back on income. You don't want to do that. There might be some year-end planning where you're on the cash basis. You don't want to collect income. You build it, but it's not collected. You're not on the accrual method. But if you get a check, you can't turn your back on the deposit. So there will be some gaming of year-end planning on that. And rightfully so. This is the first year, so a lot of people won't be that used to it, but they'll be more used to it in the second year. TJP, what do you know about Trump postponing mandatory withdrawals from retirement? That's off the topic here from today. You'll see that in the news. I do think that the tax reform 2.0 is trying to improve retirement savings. More write-offs of startup costs, good for traders. Anytime there are more benefits for retirement savings, that's great for our clients because with the S-Corp, they get into a solo 401k, they want to make contributions and grow it tax-free. So anything for retirement is good for traders, investment managers, because that's up our alley. Dana J.
Hi, Robert. I
Yes,
just wanted
hi there.
to give you a time check. It's 1:25.
Good.
So you,
And I have just a
okay.
couple of last questions. Thank you. I think it's going to work out well. So is the investment advisor concerned? Yes, we covered that. Go back. Tony C, email question. Email me questions on crypto. Absolutely. We have cover a lot on crypto. W, when, why, gain options. Yeah, you can have 475 on equity options. And last question, Craig M, have S-Corp 1256. You're not going to get it with the 1256. You need the 475. So those were quick answers I read those questions shortly. So everyone come back to the website, listen to the recording, share it with your other traders that you know. Thank you very much to Interactive Brokers. Thank you to Cynthia Tomain for having me again. We'll have another webinar next month with Interactive Brokers. Go back and look at the recording. A lot was packed into today. So thank you, everyone. And hopefully you did understand a good portion of what we covered. If you did, you get a because this was a tough one, but really worthwhile. Don't leave this 20% QBI deduction money on the table. Thank you, folks.
Well, Robert, thank you very much. A lot of information packed into today's webinar. And I want to remind everyone, we have been recording today's event, and each of you will get a direct link to today's recorded playback, as well as the webinar notes, the slides that Robert has been using today. So remember to watch your email later on this afternoon for those links. Now, also, Robert mentioned we do have another webinar just scheduled and put out on the website coming up on October 23rd. Robert will be talking about how non-residents save U.S. taxes on U.S. brokerage accounts. So do check the Interactive Broker website. Underneath the education menu, you'll find the webinars link where you can go and sign up for that event today. So with that, what I want to thank all of you as well for sticking with us for today's session and for the time that you have spent with us this afternoon. So with that, we are going to conclude our event today. Thanks so much for your participation and have a great rest of your day all. You can exit using the X in the upper right-hand corner of the screen. Thanks so much, everyone. Have a good one.